Right now, I mean, literally at this exact second, there is a trader sitting in the blue glow of their monitors, staring down 3 brutal consecutive red trades.
Oh, yeah. The worst feeling.
It's awful, right?
Yeah.
Their heart rate is elevated. The frustration is just, it's palpable. And in the next 5 minutes, just to escape that psychological pain, they're about to make the exact same decision that systematically bankrupts 90% of the market.
They're going to abandon their strategy.
Exactly. They're going to abandon their strategy and go look for a new one. Welcome to a brand new deep dive. We've been analyzing a really fascinating stack of data from various trading educators and all of these materials. We're talking FX pieces, market psychology breakdowns, TC Trading's technical dilemmas, Sasha the options coach, Vittler. They all point to one terrifying kind of counterintuitive mathematical reality.
Which is that the relentless search for the perfect trading system is, it's exactly the disease that guarantees failure.
It really is. It's wild.
Yeah. It's the ultimate paradox of the profession. You know, you step into this arena assuming that gathering more information, learning more complex methodologies, constantly adapting your approach, that's the hallmark of a smart operator.
Because that's how we're taught to succeed in literally everything else.
Right. If a tool isn't working, you swap it for a better one. But the data we're looking at today strips all of that away. The successful 10% of traders are not the ones with the most complex algorithms or, I don't know, the fastest reflexes.
Yeah.
They're the ones who possess this seemingly unnatural ability to stick to a single system for life, regardless of the chaos happening on the screens in front of them.
Which feels entirely unnatural. I mean, just wrong. And that brings us to the core mission of our deep dive today. We are going to look at the raw anatomy of discipline. We want to understand the mechanics of why strategy hopping is so fatal, how you actually survive the mathematical certainty of losing streaks without just, losing your mind.
Yeah, the mental toll is huge.
Right. And whether it's realistically possible to trade just one single methodology when the global markets are constantly mutating. So for you listening, you are constantly bombarded with new methods. But today we are stripping all that away to look at what actually works.
And the anchor for this entire analysis is a specific claim highlighted in the materials from Sasha, the options coach. He presents this really stark binary. There are thousands of indicators and trading systems out there. Thousands. But 90% of people lose because they change systems frequently.
And the 10%.
The 10% who win do so by marrying one system for life.
Wow.
It forces us to confront the fact that the primary culprit of market failure isn't like a lack of intelligence or having a slow internet connection or not having a 6-monitor setup. The culprit is inconsistency.
Let's look at the underlying psychology of that inconsistency, because it's not just a lack of willpower, right?
Yeah.
It's deeply rooted in our evolutionary biology. We are hardwired to avoid pain.
We're lizard brains at heart.
We really are. When you touch a hot stove, your nervous system doesn't ask you to analyze the temperature trajectory of the metal. It forces you to pull your hand back instantly.
Right.
In the modern financial markets, a red number on a screen, a financial loss, it translates directly to psychological and even physical pain. So the moment a strategy yields a loss, the immediate, overwhelming biological instinct is to find a different stove.
And that fight-or-flight response is completely incompatible with statistical probability. A functioning trading system is essentially just a statistical edge played out over a really large sample size.
Okay, break that down for me.
Sure. So if you have a system that wins 60% of the time, the math dictates that you must lose 40% of the time.
Right.
But the brain doesn't process probabilities well in the heat of the moment. When a trader hits 2 or 3 of those mathematically guaranteed losses in a row, the brain doesn't say, we are simply experiencing a normal distribution of our 40% loss rate.
No, the brain screams, this system is causing us pain. The system is broken. We have to abandon it immediately to survive.
Exactly. And waiting in the wings to capitalize on that exact moment of panic is the entire industrial complex of trading social media.
Oh man, I was looking through the related content surrounding our source materials, and it is an absolute psychological minefield out there. The literal noise is weaponized to feed that urge to jump ship.
It really is.
You have videos with neon thumbnails screaming about, and I'm quoting here, the one candle scalping strategy I will use for life.
Always seen that one.
Or someone promoting the one-box theory that beats 95% of complex strategies.
Let's actually unpack what those titles are doing mechanically to a trader's psychology. Take that one candle scalping strategy claim.
Yeah, what's the hook there?
Well, scalping implies moving in and out of the market in seconds or maybe minutes. The promise hidden in that title is the illusion of safety through speed. It's telling a trader who's in pain, hey, if you use this, you're only in the market for one single candle. You barely have any exposure.
So you won't feel the pain.
Exactly. Therefore, you won't feel the pain of a long, drawn-out loss.
Right.
It targets the specific vulnerability of a trader who just suffered a slow, bleeding trade.
That is so insidious. And then you have the box theory pitches. For you listening, if you aren't deep into the technical jargon, box theory generally involves drawing literal rectangles on a chart around periods where the price is just chopping sideways and then placing trades when the price breaks out of the top or bottom of that box.
Right, which is a valid concept.
It is a valid concept.
Yeah.
But it's sold as a magic bullet. It's pitched as this secret geometric code that bypasses all the complicated math. And my absolute favorite from the pile of related content is the aggressive, impossible claim, how I made $1 million in 51 days of day trading.
Yeah, and when you're sitting in the valley of a losing streak, feeling inadequate, that thumbnail is not just an advertisement. It is a psychological attack. It establishes a false baseline of reality. The trader thinks, well, if this person is making $1 million in 2 months and I'm losing $500 this week, my strategy must be definitively garbage.
Right.
This is why the educational material from FX Pesa dedicates an entire foundational chapter to a concept they simply call block the noise.
And it has to be an aggressive, conscious defense mechanism, doesn't it? You can't just passively ignore the noise. You have to build a wall against it. I like to think of it like this: changing strategies mid-losing streak is like a casino panicking because 3 tourists happen to hit the roulette jackpot in a row.
Oh, that's a great analogy.
Imagine the casino manager running onto the floor, screaming that the roulette wheel is broken, and demanding they immediately replace all the tables with blackjack. It's absurd. The casino knows their mathematical edge plays out over 10,000 spins, not 3. But retail traders treat their strategy like a single desperate bet rather than operating like the casino.
That is the perfect analogy. The casino doesn't have an emotional crisis when a player wins. They just keep spinning the wheel because they trust the underlying mathematics of their system.
Right.
But to trust the system, the trader has to be able to tell the difference between a normal losing streak and a genuinely broken strategy, which leads directly to a vital distinction FX Pesa raises. And I consider this the most important diagnostic skill in trading, separating a temporary drawdown from a fundamental flow issue.
Okay, let's tear into the mechanics of that, because on the surface, losing money feels exactly the same whether the system is working or broken. What is the actual structural difference between a temporary drawdown and a failure of fundamental flow?
Let's start with the temporary drawdown.
Yep.
As we established, no system has a 100% strike rate. A drawdown is simply the peak-to-trough decline of your account balance during a string of normal expected losses.
Okay.
Think of it like a coin flip. If you flip a coin that is weighted to land on heads 60% of the time, you have a massive
A
edge.
huge edge, yeah.
But if you flip it 1,000 times, you're still going to encounter sequences where it lands on tails 5, 6, or even 7 times in a row. If you're betting on heads, that sequence is your drawdown. The coin isn't broken, the weighting hasn't changed. The map just clumped your bad luck together into a localized cluster.
So the mechanics of the strategy are perfectly intact. You are just enduring the statistical winter.
Correct. A fundamental flow issue, however, means the ecosystem of the market has fundamentally shifted beneath your feet. The underlying mechanics of why your strategy used to work no longer exist.
Okay.
It's not a streak of bad luck. Your engine has lost a critical component.
Give me an example of what that actually looks like on the charts. How does an entire market ecosystem just change its flow?
Imagine a trader who relies on a momentum breakout strategy.
Yeah.
They buy stocks the moment they hit a new all-time high, relying on the rush of other buyers, the momentum to push the price even higher so they can take a quick profit.
Makes sense.
For a decade, during an environment of 0% interest rates and massive quantitative easing, the fundamental flow of the market supported this. Money was cheap, liquidity was everywhere, and breakouts exploded upwards.
Right, because institutions were constantly pumping cash into the system. It was a massive bull run.
Precisely. The underlying conditions were highly favorable. But then the macroeconomic environment shifts. Central banks start aggressively raising interest rates to combat inflation.
Yeah.
Liquidity dries up. The cost of borrowing money skyrockets. Now, when a stock hits an all-time high, instead of a rush of new buyers, institutions use that high price as an opportunity to sell and take profits. The breakout fails immediately. The stock reverses.
Wow.
So the trader's momentum strategy didn't just hit a string of bad luck. The fundamental flow of institutional capital that powered the strategy has evaporated.
So in the moment, looking at the screen, the trader just sees a loss. But one loss is the coin landing on tails, and the other loss is someone literally stealing the coin. How is a human being, dealing with the adrenaline and stress of losing real money, supposed to calmly diagnose which scenario they are in?
They can't do it in the moment. And they certainly can't do it if they haven't gathered the required data beforehand. This is where the concept of demo testing and obsessive journaling comes in. You see this heavily emphasized in the resources surrounding TC trading, particularly with the promotion of analytics tools like TradeZella.
TradeZella.
The only way to survive a drawdown without panicking is to have already experienced it safely.
Let's walk through the mechanics of demo testing for the listener, because it's often dismissed as, just playing a video game instead of real trading. We are talking about using a simulated account, funded with fake money, but plugged directly into the live real-time data feeds of the actual stock or foreign exchange markets.
Yeah, and the dismissal of demo testing is a catastrophic ego trap. The purpose of the demo account isn't just to figure out which buttons to click on the software. The purpose is to build a massive, personalized statistical database. If you take that single strategy and execute it flawlessly in a demo environment for 300 trades, you are going to experience drawdowns.
Yeah.
You're going to watch your fake account drop by 10% over 2 weeks.
And crucially, you are going to watch it recover.
That is the magic moment. You experience the recovery. You meticulously log every single metric in a journal, the time of day, the specific setup, the size of the loss, the sequence of the losses. You build what is effectively a psychological callus.
I like that, a psychological callus.
So later, when you transition to risking live, hard-earned capital, and you inevitably hit a 5-trade losing streak, you don't have to rely on blind faith to keep you from strategy hopping. You can open your journal and say, according to my own historical data, a 5-trade losing streak happens roughly once every 2 months, and the maximum drawdown I usually face is 8%. I am currently down 6%. I am within normal operational parameters.
It strips the emotion entirely out of the equation. You aren't guessing if the sky is falling. You are checking the weather report you wrote yourself. You mentioned tools like TradeZella, and what's fascinating about these modern journaling platforms is that they aren't just diaries. They act like an MRI for your trading behavior. They can look at your data and mathematically prove to you that your strategy is fine, but you are the problem.
Oh, happens all the time.
Right. They might highlight that your strategy is highly profitable on Tuesdays and Wednesdays, but you lose all your money on Fridays because you force trades before the weekend.
They identify the fundamental flow of your own psychology. They might reveal that you actually have a fantastic win rate, but you let your losing trades run 3 times longer than your winning trades, which just destroys your mathematical edge. Without that data, your brain will just blame the strategy, and you'll go back to digging a new hole in the desert.
Okay, I have to throw a wrench into this perfectly logical framework, because this is where the theory hits the concrete. Let's say I've done the work. I have my journal. I have my data. But the TC trading material brings up a massive dilemma that threatens this entire philosophy. They ask a very blunt question: is one strategy too simple of an approach? You can't realistically just trade the same strategy forever.
Right.
It's the most uncomfortable question for the one strategy purists, because it addresses the undeniable reality that the market is a living, breathing ecosystem that constantly goes through different seasons.
Let's visualize this using the specific strategies TC trading references. They pit the dollar-cost average strategy against a trendline break strategy. For the listener, let's explain the mechanics of these two entirely different approaches to the market. Let's start with dollar-cost averaging, or DCA.
DCA is perhaps the most fundamental long-term accumulation strategy in existence. The mechanic is simple. You commit to buying a fixed dollar amount of a specific asset at regular intervals, regardless of what the price is doing.
Okay, so just blind buying. Pretty much.
Yeah.
If you decide to buy $500 of an index fund on the first of every month, you execute that order whether the market is making all-time highs or whether it's crashing. When the price is high, your $500 buys fewer shares. When the price is crashing, your $500 buys more shares, effectively lowering the average cost of your entire position over time.
It's a strategy built on the assumption of ultimate long-term macroeconomic growth. You don't care about the daily chart.
Not at all.
Now, Contrast that with the trend line break strategy, which requires intense focus on the immediate chart geometry.
Right. A trendline break strategy requires the market to be moving in a highly directional manner, either up or down. Picture a stock chart where the price is making a series of higher highs and higher lows, climbing like a staircase.
I can picture it.
A trader will draw a literal diagonal line connecting the bottom of each step. The strategy dictates that as long as the price stays above that diagonal line, you stay in the trade. The moment the price breaks down through that line, the trend is considered violated, and you sell immediately to short the market, betting it will fall.
It relies entirely on momentum and clearly defined angles. So here is where the 90-10 rule seems to crash and burn. I am a disciplined 10%er. My chosen system for life is the trend line break. I've demo tested it, I trust the data, but what happens when the market ecosystem changes and we enter a season where there are no staircases? The market just chops sideways. It goes up $2, down $2, up $2, down $2 for 6 months.
You are describing a consolidation phase, and it is the graveyard of trend traders. In that environment, your diagonal trend lines are useless. If you try to draw them, the price will break them every few hours, triggering a flurry of false signals. You will buy, the price will immediately reverse. You will sell, the price will immediately bounce. You will suffer death by 1,000 paper cuts.
Okay, so if we extrapolate the options available to a trader trapped in this scenario, and while the source doesn't list these out like a menu, logically, you are staring down the barrel of 3 distinct choices. Option 1. You realize your trend strategy is getting chopped to pieces, so you abandon it, open up YouTube, and search for a sideways market scalping strategy.
Which immediately violates the core rule. You have just become a strategy hopper. You have rejoined the 90%. You're letting the immediate pain dictate a fundamental shift in your methodology.
Exactly. You've lost the discipline. Option 2. You refuse to adapt. You stubbornly force your trendline break strategy into a horizontal market. You keep drawing diagonal lines on a flat chart.
And you slowly bleed your account dry. It is the equivalent of trying to use a screwdriver to hammer a nail because you refuse to acknowledge that the task has changed. You mistake stubbornness for discipline.
Which leaves us with option 3. And this might be the most psychologically demanding requirement in all of finance. If you aren't allowed to change your strategy, and your strategy mathematically guarantees losses in the current environment, the only path forward is to have the absolute supreme discipline to sit on your hands and do nothing. You have to wait until the environment changes back.
Waiting is the true secret of the 10%. We think of a strategy entirely as a mechanism for action. When to buy, when to sell, where to put the stop loss.
Yeah.
But capital preservation, the deliberate choice of inaction, is the most vital component of any strategy.
Let's ground this in the real assets mentioned in the TC Trading source list. They bring up videos asking why is gold crashing and discussions around Bitcoin. Let's describe what a Bitcoin chart actually looks like over a multi-year cycle because it perfectly illustrates the agony of waiting.
Picture the historical price action of Bitcoin. It is characterized by violent parabolic vertical explosions in price, followed by devastating crashes. But what people forget is what happens in between. After a crash, Bitcoin will often enter a crypto winter.
Just flat.
The chart flatlines. For 18 months, the price will just bounce around in a boring, tight little range. Volume dries up, volatility disappears.
It becomes the most boring asset on the planet.
Exactly. Now, if your single mastered system is a high volatility breakout strategy designed to capture those massive parabolic moves, and you try to trade that strategy during an 18-month crypto winter, you will destroy your capital.
Right.
The discipline isn't just following your entry rules when the setup appears. The discipline is looking at the chart every single morning for 18 months, recognizing that your setup is not there, and closing the laptop.
Wow. It forces us to ask, is doing nothing actually a core part of the system itself? If the system says do not trade, if volatility is below X, then sitting out isn't abandoning the system, it's executing the system flawlessly.
Exactly right.
But let's be intensely realistic about human nature here. If I sit at my desk for 3 weeks or 3 months and don't make a single trade because my specific trend isn't appearing, I'm going to feel like an absolute failure. How does a trader ever grow their account? How do they justify the sheer boredom?
This profound tension between the need to stick to one strategy and the need to remain active and profitable across different market seasons, it's resolved beautifully by Sasha, the options coach. Sasha introduces a structured roadmap for a trader's life cycle that allows for evolution without falling into the trap of strategy hopping. He breaks trading down into 3 pillars: mindset, method, and money management.
And crucially, he outlines a chronological progression. The roadmap isn't static. It starts with learn and evolve, focusing on the absolute basics, and then moves to diversify with experience as your capital and competence grow. Let's break down how this actually works mechanically.
The synthesis here is brilliant. You absolutely must stick to one single strategy initially. Sasha specifically mentioned starting with something fundamental, like covered calls in the options market.
Let's explain the mechanics of a covered call for the listener who might only be familiar with buying standard stocks, because it illustrates what a foundational strategy looks like. It is essentially renting out your assets, isn't it?
That is a highly accurate way to visualize it. Let's say you own 100 shares of a stable company, like Apple. Those shares are just sitting in your account. A covered call strategy involves you selling a legally binding contract to another trader.
Okay.
This contract gives them the right, but not the obligation, to buy your 100 shares of Apple at a specifically agreed upon higher price anytime before a certain expiration date.
So if Apple is currently at $150, I sell them the right to buy my shares at $160 next month.
Correct. And in exchange for giving them that right, they pay you an upfront cash premium. That premium goes straight into your account as income. It's like collecting rent on a property you own. If Apple stays below $160, the contract expires worthless, you keep your shares, and you keep the rent money. It is a lower risk, income-generating strategy that forces you to understand the mechanics of options, time decay, and asset ownership.
It's mechanical, it's relatively slow, and it's predictable. It's the perfect training ground. So Sasha's point is that you trade only covered calls. You master the execution. You learn how the premiums fluctuate. You journal the results. You do not hop to a new strategy because a covered call went against you, or because your neighbor claims they made a fortune day trading meme coins.
You master the boring stuff first. You achieve absolute measurable consistency with that single tool. But, and this is the evolutionary leap, you don't necessarily trade only covered calls for the rest of your natural life.
Right. Eventually you grow.
Exactly. Sasha's model explicitly encourages you to diversify with experience. Once you have achieved mastery, and once your account has grown significantly through the consistent application of that first strategy, you earn the right to add a second strategy to your toolkit.
Okay, I love this distinction because the motivation is entirely different. You are adding a new tool to handle a different market environment. Perhaps a strategy designed specifically for that sideways choppy market we discussed earlier. You are adding from a place of success, abundance, and capitalized strength.
Contrast that with the strategy hopper. The hopper adds a new strategy from a place of desperation, panic, and financial weakness because they're trying to outrun a loss. The master builds a diversified toolkit over years. The amateur shuffles through 10 broken tools in a week.
It's like learning martial arts. You don't learn a white belt punch, try it in a sparring match, get hit, and then immediately say, well, punches don't work. I'm only doing jump kicks now.
Right.
You master the punch. Only when you are a black belt do you start mixing disciplines.
That's spot on.
Let's look at the 3 pillars Sasha uses to support this evolution, because they explain why the method, the actual strategy itself, is only a fraction of the puzzle. Look at the title from the $V source. The one simple and proven strategy nobody talks about. That title is purely focused on the method. It's selling the shiny object.
The method is just the engine of the car. It dictates how the power is generated. But an engine is useless and incredibly dangerous without the other 2 pillars, money management and mindset. Even if you possess the most mathematically proven, historically profitable trading strategy on the planet, you'll inevitably go bankrupt if you fail at money management.
Let's run the math on that to show exactly how money management saves you when the method hits the inevitable statistical winter. Let's take a $10,000 account.
Okay, let's assume your highly profitable method hits a standard temporary drawdown of 5 consecutive losses. If your money management is non-existent and you are risking 20% of your total account balance on every single trade because you are greedy and want to double your money quickly,
Which people do.
all the time, those 5 losses don't just hurt you, they completely wipe you out. Your $10,000 is gone. You are bankrupt.
Game over. And the tragic irony is that the very next setup trade number 6 might have been the massive winner that validated the entire system. But you can't take the trade because you have no capital left.
Exactly. Now apply professional money management to the exact same scenario. The strict rule is that you never risk more than 1% of your total account equity on any single trade. When you hit those same 5 consecutive losses, your $10,000 account only draws down by roughly $500. You are down 5%.
Which is nothing.
You are perfectly fine. You have preserved your capital, and you survived long enough to see the strategy return to profitability. The method tells you when to enter the market, but money management dictates whether you survive the experience.
So if method is the engine and money management acts as the brakes to keep you from destroying the account, mindset has to be the steering wheel. It is the overarching psychological control required to actually execute the first 2 pillars.
Mindset is the invisible glue. It is the raw discipline required to follow your 1% risk rule on a day when you are furious at the market and desperately want a revenge trade to make your money back. It is the emotional control necessary to sit on your hands and endure the boredom of a sideways market. And crucially, it is the resilience required to combat the psychological warfare of FOMO, the fear of missing out.
FOMO is the ultimate strategy killer. You are sitting there patiently waiting for your trendline break setup, which hasn't appeared in weeks. You open social media and you see 50 different accounts posting screenshots of massive profits they made buying a random altcoin that just skyrocketed. The physical sensation of FOMO is agonizing. It feels like you are being left behind by society.
And the mindset pillar is what allows you to look at those screenshots and rationally conclude, that move did not fit my system. It was not my setup. Therefore, I missed nothing. I protected my capital.
Easier said than done.
Oh, absolutely. Maintaining that level of ironclad psychological defense in isolation is nearly impossible for a human being. We are social creatures.
Which brings us to the final critical piece of the puzzle, the environment. Building that mindset requires an ecosystem that actually fosters discipline rather than tearing it down. This is where we look at the final components from FXPISA and VidDollar. FXPISA dedicates a section to the importance of community, while VidDollar heavily emphasizes the concept of live trading and taking on a public trading challenge.
Why do they emphasize community so strongly? Because retail trading is, by default, one of the most isolating professions on earth. It is just you, a computer screen, a mouse, and the flashing numbers. That inherent isolation dramatically exacerbates every psychological vulnerability we've discussed. When you are sitting alone in a room entirely cut off from the outside world and your account is slowly bleeding during a drawdown, the doubts don't just whisper, they scream.
The echo chamber of your own anxiety amplifies everything. You start to believe that you are the only person on the planet taking losses, that the market is personally out to get you, and that everyone else is getting rich effortlessly using the one-candle scalping strategy.
Being part of a structured community, or participating in live trading environments where you watch veteran traders execute their strategies in real time, acts as a vital psychological anchor. When you watch a professional trader, someone you respect, take a loss on a live stream, and you see them calmly log it in their journal, shrug it off, and move on to the next setup without changing their system, it fundamentally rewires your brain.
It normalizes the pain. It proves that losing is a mechanical part of the business, not an indictment of your intelligence or a sign that your strategy is broken.
Exactly. It provides a daily reality check against the flashy, no-loss clickbait that floods your algorithms. You realize that discipline isn't just an internal solitary trait that you have to magically summon through willpower. Discipline is often scaffolded and supported by external structures. We talked about how demo accounts and journaling provide statistical grounding. A solid community provides emotional grounding.
I love the concept of the anchor, but I have a serious question about the reality of trading communities. If FXPISA's foundational rule is to block the noise, how do I ensure that by joining a Discord server or a trading group, I'm not just plugging my brain directly into a concentrated high-voltage source of different noise? What if the community I join is just 1,000 people spamming rocket emojis and shouting about the next hot stock tip? Does the community just become a collective strategy hopping mechanism?
This raises the absolutely critical issue of curation. You have to be ruthless about the environment you choose. There is a massive defining difference between a noise-generating chat room and a true community of practice.
How you tell the difference?
Noise is entirely focused on the outcome. It's people sharing unverified screenshots of massive wins, debating which new magic indicator is best, and feeding each other's SOMO. It's the guy typing in all caps, "Forget your system, buy gold right now before it explodes."
A true community, then, in the context of building that 10% discipline, has to be focused on the process, not the outcome.
Precisely. A high-value community is built around shared experience and mutual accountability to Sasha's 3 pillars. In a good community, members don't argue about whether a trendline strategy is better than a DCA strategy. They understand that different systems work for different people, Instead, they hold you accountable to your own chosen rules.
So it's more about execution.
The conversations are radically different. They ask, did you follow your entry criteria today? Did you stick to your 1% risk limit when you took that loss? Have you updated your trade zealot journal for the week?
So a valuable community doesn't give you hot tips to make quick money. They act as a mirror. They reflect your own operational discipline back at you. If you deviate from your system, the community is there to call you out on it before you blow up your account. They help reinforce the walls that keep you in the 10%.
It creates an ecosystem of consistency. When you surround yourself with people who prioritize risk management and system loyalty over quick profits, the magnetic allure of strategy hopping begins to fade.
Okay, this has been an incredibly dense and revealing exploration of what actually separates the winners from the massive graveyard of losers in the market. Let's trace the arc of what we've unpacked today. We started by confronting the brutal statistical reality that 90% of traders fail. And they fail not because the market is rigged against their intelligence, but because their biological aversion to pain causes them to constantly hop from one unmastered strategy to another.
They dig 100 holes that are only 1 foot deep and then complain they can't find water.
We learned that the only way to stop digging shallow holes is to differentiate between a temporary drawdown, the mathematical cost of doing business, and a fundamental flow issue where the market ecosystem has actually changed. We broke down the vital mechanics of demo testing and rigorous journaling, proving that data is the only antidote to emotional panic.
We also confronted the harsh reality that market conditions do change, and that the ultimate test of a single strategy isn't how much money it makes during a trend, but whether you have the supreme discipline to sit on your hands and wait when the market goes sideways.
And finally, we synthesized this with Sasha's evolutionary blueprint. You master the boring fundamentals first. You build an ironclad framework of mindset and money management to survive the drawdowns. You only add new strategies to your toolkit from a place of deep experience and capitalized success, never from a place of desperate hopping. And you safeguard all of this by curating an environment and a community that holds you accountable to your process, ruthlessly blocking out the noise.
It requires a profound shift in perspective. You have to stop looking outward for the magic indicator and start looking inward at the architecture of your own psychological resilience.
And what is truly amazing about this deep dive is how universally applicable these mechanics are. Whether you are listening to this because you want to conquer the foreign exchange markets, or you're trying to build a startup, or you're learning to code, or even trying to get into shape, the trap of inconsistency and the seductive whisper of the new effortless system is a universal human hurdle. We all want the results without enduring the statistical winter.
The mechanics of mastery and the requirements of discipline do not change, regardless of the arena. Mastery always requires enduring the mundane.
Which brings us to a final, slightly provocative concept. I want you to mull over as you step away from this deep dive and back into your own pursuits. We spent this entire time dissecting the intense discipline required to stick to one strategy when you are losing money, when the pain is high. But I want to flip that on its head. Think about this. What if the ultimate mark of a true master isn't the complex brilliance of the strategy they choose, or even their stoic ability to handle a financial loss? What if the highest, most difficult level of mastery is the incredible, agonizing boredom they are willing to endure when their system demands that they do absolutely nothing?
The profound discipline of inaction.
Exactly. So look closely at your own life and the goals you are chasing right now. Whether you are analyzing charts, building a career trajectory, or trying to master a new skill, ask yourself a hard question. When you abandon your current approach, are you changing your strategy because the data proves it is genuinely, fundamentally broken? Or are you just changing it because you are bored, the initial excitement has worn off, and you want to feel the dopamine hit of starting something new? Are you putting in the reps to master your one system, or are you secretly operating as part of the 90% who will spend their entire lives hopping from one magic bullet to the next?
It is a diagnostic question that only you have the data to answer.
Keep that in mind the next time you feel the urge to stop digging, move 10 yards to the left, and start a brand new 1-foot hole.